negatively impacted is the BFSI and the NBFC sector in particular. And to understand what the outlook is going forward for this sector, we now have Shweta Daptardar, Vice President, Lead Analyst, Diversified Financials at Elara Capital, now joining us. Shweta, afternoon, and thank you so much for joining us today. What do you make of the 25 bips rate cut that has come in and its impact on NBFCs? And which sub-segment within the NBFC sector you think will benefit the most? Will it be the retail arm or the microfinance segment which will benefit the most?
Afternoon, and thank you for having me. So NBFCs have navigated distinct set of challenges in the last quarter and for last 1 year. So definitely, this another 25 bips rate cut and liquidity improvement augur well for the NIM expansion, especially for NBFCs. We certainly believe that larger NBFCs will be bigger beneficiaries, and retail asset classes such as which are largely fixed rate book, that is namely vehicle financiers, vehicle loans, LAP and home loans will tend to benefit the most.
So these are some of the sub-segments which are likely to benefit the most. Does this improve liquidity within the BFSI and the NBFC sector as a whole? And on account of that, will the entire sector then benefit?
Yes, so you're right. Because liquidity at the NBFC level or at the NBFC balance sheets have been tight for past several quarters. Although systemic liquidity has been holding up well, and bank transmission on rates have been certainly gotten delayed, especially for the smaller names, like I mentioned earlier. So liquidity boost, and while it was also mentioned by the governor, uh, depending upon the evolving market conditions, the liquidity influx will continue. So definitely this bodes well for most of the NBFCs. Going forward, we certainly believe that larger part of growth is going to be risk calibrated. Cost of borrowings is going to definitely help NIM expansion, and earnings growth is going to take shape up in the second half of this fiscal.
Okay, so lower cost of borrowings will aid net interest margin expansion. But if you can take us through the timeline as to how soon will NBFCs will be able to pass on the benefit. Cumulatively for this year, RBI has now lowered repo rate by 125 basis point. How much of that has already been transferred, and how much more time will it take to reflect the additional 25 basis point rate cut?
Yes, so larger part of transmission is expected to get transmitted in the second half or the Q4 of this particular fiscal. Like mentioned, there have been certain delays in bank transmission lower rates. So that is definitely putting this particular translation at a slower pace. Now that second half bodes well for better seasonal quarter in terms of credit growth as well, we do see 20 to 80 bips expansion in net interest margins for next 3 quarters.
Expecting net interest margin expansion, but what's your thought when it comes to rural demand? Will the rate cut aid rural demand more than urban demand? And what about microfinance asset quality then? Is that likely to improve as well going forward?
Yes, so rural demand uptake is around the corner, especially fueled by the GST simplifications that we saw at the fag end of the last quarter. So larger part of benefits will flow through now in the upcoming forthcoming quarters. Also, last 2 quarters, the rural cash flows were also pressurized by the headwinds from the monsoon, and also from certain stress coming from the key sectors such as MFI, micro lab, and also certain unsecured business loan asset domain. Going forward in second half of the fiscal, we believe lot of pressure is easing, especially in the MSME credit risk challenges. We also believe MFI is in the last leg of the pain. So definitely the incoming data has not been as strong as we had envisaged. But having said that, the unique borrowers and the business growth augmentation has picked up really well. We also have to come to the terms to the fact that the growth or recovery in MFI is going to be slightly gradual because these were structural challenges which emanated from the over leveraging scenario that was built up since past 2 years. But regulatory relaxations in terms of the qualifying asset share coming down from 85% to 60% for MFIs definitely paves way for diversification and helps them board the business cyclicality challenges better. On the other hand, we had another key regulatory relaxation on gold loans, which will be effective now April 2026 onwards, where the LTV ceiling has been raised from 75% to 85%. So that is another positive which bodes well for the overall credit scenario that we are expecting to turn around in second half.
All right, and since you also spoke about over leveraging, now with the additional rate cut, Shweta, do you expect the chances of over leveraging to increase on account of cheaper money being available in the market?
Banks and NBFCs have already turned cautious since past couple of quarters. Also, MFIN guardrails have enabled to curb incremental asset quality challenges. So, regardless of the easing in the system or the regulatory challenges, the lenders per se have grown cautious. And even in the credit card segment, we also came up with a note saying that this is almost the last leg of balance sheet cleanup for the credit card players. So, considering the prudency measures from the lenders per se, we do not believe any asset quality challenges to sort of flare up in the forthcoming quarters. Having said that, a lot of lending through digital channels, fixing the sourcing or the origination criteria by most of these lenders is also auguring well for the depleting asset quality challenges. So yeah, we remain positive on the NBFC credit risk sort of parameters.
You continue to remain positive. That's the word coming in on the entire NBFC sector. The basket is in focus on the back of RBI MPC outcome. Shweta, thanks so much for taking your time out and joining us here on ET Now and helping us understand what impact will the rate cut have on the entire NBFC sector. Thanks so much for joining us today. On that note, we need to slip into a very short break, but our coverage will continue on the other side. Don't go anywhere.